Chris Toomey with Morgan Stanley Private Wealth joins us here at Post 9. Nice to see you.
Nice to see you.
Do you have high hopes for 26 and strong returns like this year?
We do. We do expect it to be a good year next year.
You do? Why so? What's going to carry it?
I mean, I think there's a lot of secular tailwinds. You talked about it earlier on the show. You've got a situation where earnings look very promising. You've got breadth improving. You're in a situation where you actually have fiscal policy starting to kick in with Big Beautiful Bill, and then the monetary policy has also been very accretive. You throw in some deregulation, additional M&A, animal spirits start coming in. It looks pretty promising.
Wow. All right, so that's a run it hot rally. Is that an everything rally?
You know, look, I think you're going to have winners and losers here, and I think you're bound to see a fair amount of volatility increase. I don't think that this is a situation where there aren't risks, but I do think this is a situation where you could see some leadership changes. You could see this rally kind of broadening out. And while tech will certainly do well, I don't know necessarily that it's going to lead the way that it has the last 3 years.
So what has been happening more recently, you think, is a template for what next year could look like?
Potentially. Look, I think you're in a situation right now where, you know, there's a reason why markets have been concentrated. The lion's share of the earnings growth has come from those types of companies. We're starting to see a situation where, in addition to some of these tailwinds affecting these other companies that have been kind of overlooked, that you should start to see them starting to do well on pretty low expectations.
I don't know about expectations being so low. I mean, the Russell, for example, is up 6% in a month. It's had a good year. It's up almost 14%.
Yep.
You look at a lot of other sectors within this market, industrial's up 18, financial's up almost 14. There actually is a lot of broadening that's happened in this market.
It's happening, but I think expectations for next year are relatively lower versus the Mag 7. So I think in our minds, that's going to continue to play itself out. You're in a situation where earnings will be a lot easier to overcome in some of these sectors, and you've got that secular tailwind that should be beneficial too.
You mentioned it's not like there aren't any risks. What are the principal risks, do you think?
Look, I think there's the big risk, I think, in our minds are kind of twofold. One is around inflation. I think part of the reason why we've had such a good year this year is you had a lot of front loading with regards to some of that supply and inventory buildup in anticipation of the tariffs with regards to Trump. As that inventory burns off, are we going to be in a situation where prices have to be higher, that companies can't not necessarily pass them over to the consumers, and you're in a situation where inflation ticks up? The other is a concern with the amount of debt that we're issuing. You're talking about a situation where the Fed's cut 3 times this year, and you look at the 10-year and it's basically flat for the year. So there's something going on in the middle and the back end of the curve with regards to term premium. Is it a concern with regards to inflation? Is it a concern with regards to the amount of debt that's outstanding? That could be a concern.
I mean,
that
maybe it's all of the above, but I mean, a little bit. But if growth is strong enough, I mean, there is a belief in some corners that you can just grow your way out of a lot of this.
Absolutely.
Maybe not fully out of it, but you can grow your way out of it enough to stop the market's fixation on it.
Totally, and I think the fact that everyone's talking about it is a good thing. And I think we're in such an embryonic piece with regards to this build out within AI that it's probably still too early for us to get too far ahead of ourselves. I think from our standpoint, you know, there is so much demand and the supply is yet to get online that we still have a fair amount of runway before that becomes a real issue.
You still think we're in the early innings of this whole AI story?
I think we are. Like, I think if you look at it, there's a combination of things that we're dealing with. One is just the gradual adaptation and then the demand with regards to compute and the ability to get it. And I think that's why you're seeing so much money flowing into areas around this, because I think it is going to be a situation where it could be a winner-take-all strategy. And so everyone wants to be prepared in order to take on each other.
Well, that's the problem I have. Is like if you and a lot of other people believe that we're in the early innings, then why would that trade fall out of favor if the fundamental metrics of it prove that you and others are correct?
Price, right? So the market could get too far ahead of itself. You could have a situation like you mentioned Oracle before, not necessarily that I'm talking about them specifically,
right?
But you saw the market immediately race up high and pull back pretty gradually. So if prices run, if you get too much speculation, you could see a pullback.
But you don't think we're there yet?
No. I think you stay the course. I think, the other concerns that we would be looking at is areas within the credit markets. You've got a lot of supply going in. Spreads are tight. You want to diversify out some of that risk. But our biggest call, as you know, is probably in the private markets. You guys were just talking about probably one of the largest IPOs coming forward. Mm-hmm. That's going to create an additional amount of liquidity coming back into the system. We think all of that's very healthy.